Aloha, inspired moneymaker. Thanks for tuning in. If this is your first time here, welcome. If you're returning, welcome back. Let's all be inspired moneymakers together. I just want to share a quick story. Back in 1990, my dad handed me a copy of Peter Lynch's One Up on Wall Street. Great book. I was just a teenager, but that book opened my eyes. It taught me that investing didn't have to be mysterious. You could start just by paying attention to the products and services that you already use. That simple idea planted the seed for a lifelong curiosity about the markets. And fast forward to today, and we're all navigating a stock market that feels more complex than ever. Inflation, interest rates, global uncertainty. So how do you invest confidently for the long term without getting overwhelmed by the noise? That's exactly what we're going to discuss today. In this episode of Inspired Money, we're talking long-term investing strategies, what works, what doesn't, and how to stay grounded through markets, ups and downs, whether you're a long-time DIY investor or just starting out. Maybe you hire other managers or a financial advisor to handle it for you. But I think that today you'll leave with real insights that you can put to work. We've got a rock star panel of investment pros joining us, people who've managed billions, built out their own firms, helped others grow and protect their wealth. You'll hear how they approach stock picking, risk management, market cycles, and the emotional roller coaster that can come with being an investor. So grab your notebook, get settled in, because this is going to be a fun, educational, and actionable conversation. Before we dive in, I want to thank today's sponsor, and this is a new one. If you sit at a desk all day like me, you probably know the toll that it takes on your body. For me, it was lower back pain, made worse by a compressed disc that I have in my lower back. And I'll be honest, it started affecting how I work, how I felt, even how I slept. So I knew that I needed to make a change. My brother Chris, who is one of the panelists today, he's been using a standing desk for a long time. So I started researching standing desks because that's what I like to do. I do a lot of research. That's when I found Office. I had never heard of the brand, but as I dug deeper, I found that people swore by it. I love how their sway desk just works really well. I bought one, and it has a beautiful, solid white oak top. And I'm telling you, it's been a game changer. It's beautiful, it's stable, it's sustainably made and powerful. It's got dual motors that can lift up to 360 pounds effortlessly. I haven't laid down on it yet, but maybe I'll try that eventually. The programmable control panel saves the seat stand heights for up to 4 users. And it's great. Office doesn't just build desks, they build better workplaces or workspaces. It's made in Canada, certified B Corp, sustainably sourced wood, and they even donate a portion of profits to the David Suzuki Foundation. So if you're dealing with back pain like me or poor posture like me, you want to feel better, check out the Sway Desk. You can go to inspiredmoney.fm/standing desk. That's an affiliate link, and using it supports the show. I never knew that I could get excited about a desk, but I'm loving this desk. Now let's welcome in our incredible panelists for our discussion today. Let me start with our first guest, David Stein, an experienced investment strategist who once managed billions. He served as chief investment strategist and chief portfolio strategist at FEG Investment Advisors, a $15 billion firm where he co-led a 21-person research team. David also founded and managed FEG's $2.2 billion asset management division, setting its investment philosophy. Today, he brings that institutional insight to individual investors through his top-ranked podcast, Money for the Rest of Us, his best-selling book, and Asset Camp, a fintech platform designed to help investors build more resilient portfolios with confidence. David, welcome back.
It's great to be here. Thanks, Andy.
And you're coming to us from north of the border.
I am. We're traveling Quebec, and that's why I look like I'm working from a dorm room. So Airbnb at its best.
Please eat some poutine for me later.
I had plenty of that.
I'm excited that all our panelists have been on the show before. Next, we have Mariko Gordon, CFA and CFP. She's founder and CEO of Uzume LLC. She's a trailblazer who built Daruma Capital Management from scratch into a $2.5 billion investment firm known for its unconventional and thoughtful approach to small cap investing. With more than 3 decades of experience, Mariko now advises individuals and families on everything from investing to navigating life's big transitions. She's also a passionate advocate for women's empowerment and financial literacy. Great to have you back, Mariko.
Thank you, Andy. It's always so much fun to be here.
Mike T in the house. Mike Taylor joining us, portfolio manager of the Simplified Healthcare ETF, ticker symbol pink. Just for Mike today, this is hard to see. I'm wearing a pink.
Ooh, big fan, big fan.
Under my shirt. And the pink ETF is the first ETF to donate all net profits to the Susan G. Komen Foundation. Mike has spent over 20 years managing healthcare-focused portfolios at top hedge funds, including Citadel, Millennium, and Diamondback Capital. He's widely recognized for running one of Wall Street's top-performing healthcare hedge funds. And now he's using his expertise to drive impact in the fight against breast cancer. Mike T, welcome back.
Thank you so very much. And I'm pleased to say that pink, actually, there's things I can't say. You'll have to draw your own conclusions when you look at the performance of pink since inception versus every other actively managed ETF. I think you'll be very pleased if you're a holder. That's how I'm allowed to say it.
Very nice. I like very compliant. And rounding out our panel today, my brother, Chris Wang. He's managing partner and director of research at Runnymede Capital Management, where we've worked together for years. Chris started his career as a securities analyst at the College Retirement Equities Fund, also known as CREF. And in 1999, became assistant portfolio manager to the CREF growth accounts, one of the largest pension funds in the country, managing over $16 billion in that growth account. Today, Chris brings that institutional experience to Runnymede clients, helping them to navigate markets with a disciplined, research-driven approach. Chris, great to have you here.
Hey, thanks for having me back, and excited to be here with the panel. I just want to give a quick hat tip to Mariko. Many years ago, we looked at Cadence Design because of Daruma. So still have it, has been an unbelievable stock. And of course, Mike T, always inspired to hear your point of view. And David, just met you. So looking forward to learning from you as well.
He's inspired to meet you. Well, we've got a lot to cover. I think we're going to have a fun conversation today. We do have segments, but feel free, all panelists, to chime in on what current events and topical things may fit into the context. Let's go straight into segment 1.
Long-term investors can choose from 3 main strategies: value, growth, and dividend investing. Value investing focuses on undervalued stocks with strong fundamentals, using metrics like price to earnings and price to book ratios to identify potential opportunities. These stocks may take time to appreciate, but can offer strong returns over time. Growth investing targets companies with high revenue and earnings expansion, often in sectors like technology and healthcare. These stocks can deliver substantial gains, but come with higher volatility. Dividend investing provides passive income by selecting stocks with consistent dividend payouts. Key metrics include dividend yield and payout ratio, ensuring sustainable returns. Investors can blend strategies by diversifying portfolios based on risk tolerance and financial goals. Balancing value, growth, and dividends helps reduce risk while maximizing long-term returns in changing market conditions.
David, get us started. I know that you have an approach putting together portfolios that include public and private investments. How do frameworks help individuals or even investing committees to select between value, growth, and dividend strategies?
Well, our approach has generally been what I call asset garden approach. So we're asset allocators. I did it as an institutional advisor. I do it now as we work with individuals and advisors. I think, when you talk about value, growth, dividends, the first question is, and we have, sounds like three very smart, active stock selectors. And what they do well at is identifying companies, be they value, growth, dividend, that are doing better than the consensus. My background is having spent years working with active managers trying to select them. Most aren't able to do that and identify those stocks that beat the consensus. Some do. And so as an individual investor, it's not something I've done. It's not something I want to do because I know I'm not competitive at it, because it matters who is on the other side of the trade. What do they know that I don't? And I don't believe I have the skill set to identify individual companies that'll do better than what's already priced into the stock.
Where do you fall in that asset allocation, active managers versus passive managers then?
In my case, I've always been an allocator. So if I can get the factor exposure I want, the underlying drivers are attractive, then I'll generally have used ETFs. And I did that at my old firm back when institutions didn't invest in ETFs in the early 2000s, and have found that just a more effective way to implement our view rather than allocate it to a handful of active managers that end up, and sometimes on the overall portfolio basis, they cross each other out given their particular views. And so it's sort of an active passive approach, but the active position is as part of the top-down allocation.
Mariko, you're a great analyst and portfolio manager. Chris called out cadence. That one always is at the top of my mind too. How do you explain to people the difference between investing and gambling?
It's interesting because so much of what passes for investing these days is really speculation and gambling. So, and the other thing I'll just footnote to cadence, I don't know, you guys saw that Lip-Bu Tan, who was the CEO of Cadence, is now the CEO of Intel. And I haven't done any work on it, but if anybody has the insight, he's a former board member as well of Intel. It'll be really interesting to see what he does there under his leadership, given what's all the challenges ahead there. I think for the difference between investing and gambling, I think is the approach that you take to it. So like now you have options where you can bet on whether the S&P is going to be up and down on Friday at 4 p.m. right for the day. I mean, that's not investing. I think so. I think basically if you have a longer term horizon, you're investing. Probably. And then, so it's both a function of time horizon and it's also a function of the instruments that you're using. So if you're using instruments that expire and are worthless, right? Options are very useful, but they're a weapon to be deployed very strategically with a very specific use. And I would say I would, use it as either leverage or a defensive hedge, right? So for me, the investing is a function of time horizon, objective, and then also the instrument as well. Like, does it have legs? Can it last long enough to recover if anything goes wrong?
Yeah, so an element of quality, it sounds like.
Mm-hmm.
Just if I could jump in, it's something that I've looked at a lot. Investing versus gambling versus speculation. And a simple definition for me is investing is something that has a positive expected return. Gambling is something a negative expected return. When you go to Vegas, you're gambling, you're not going to win, but you do it for fun. And speculation is where there's a disagreement. Is cryptocurrency speculation? Yeah, so is gold, so are other futures, but that's sort of a simple framework to think about it. If it has a positive expected return, then it's an investment.
Mike, give us some insight into one of your favorite places on earth that's working on the desk of a major hedge fund. Talk about strategy. How has your investment strategy changed over the years?
Oh, you're talking to me?
Yeah.
Well, in order to excel in the hedge fund arena, you really have to be a chameleon. It's really funny. the fixation of the managers up top, or anyone who's investing in your hedge fund, when you talk to them, they love to see that PowerPoint presentation with all the details on what your process is. And they're fixated on this bulletproof process that outperforms. And the reality is, if you stick to that process, you will blow up, because you have to reinvent yourself quite often in this business and have a menu of sort of costumes that you put on. Okay, I'm going to be this. Okay, I'm going to be Harry Houdini now. And you have to change the way that you do things in order to make money. The fixation is always on being right. And being right is not making money. They are two different things. Being right is for people who write books. Making money is for people who run hedge funds. And they are not the same thing. So you have to be steadfast in understanding that the setup that you have on right now, hopefully is a winning one, and that you have to change the way that you think and understand in order to adapt to a changing environment. And that's really what I did a lot of at Millennium, changing my process, changing how I looked at things, and always being aware on not only what the bottom up companies are going to do, which frequently turns into earnings and frequently turns into stock performance, but also looking at what all the benchmarkers and others in the business have to do so far as benchmark weightings and so forth. And one point I'll come to right now, we've seen, for instance, a big move in the Qs, QQQ or NASDAQ. And there's been a lot of very large names not participating enough in that rally. And it is a real problem for overall markets, whether they know it or not yet.
So is it? Yeah, go ahead, Mariko.
No, I was just going to say, Robert Sutton, I think, put it really well. It says you have to have strong opinions, weakly held, right? So to be willing to change your mind, and that's not something that that psychologically we're wired for, right? Our egos get very caught up in our opinions. Process, I second your motion, Michael. You have to have a process that is flexible and evolvable, but also like has a North Star too. So it's and I would guess, that there's a fundamental underlying principle under the way that you've invested that has allowed you to be a chameleon. There's a chameleon nature that allows you to be a successful chameleon, but it's not like one day you're a wolf, the other day you're a bear, you're a chameleon, right? With a chameleon nature.
Yeah, I think that everyone who does this successfully at that level, you have two types of people. You have, first of all of them have 150 IQ, but the ones that survive are the ones that have 150 IQ and represent themselves as an idiot. And if you walk into every day assuming that you are the dumbest person on earth, that's a really good start. And so, I look at it like this, is that my book, even the pink book, is going to be a sea of mistakes. And that's what I'm fixated on, is my mistakes. But for some reason, at the end of the week, the end of the month, the end of the year, it has outperformed. And it is surviving your mistakes and excelling at the moment that you're not making a big mistake. So that's what I'm really fixated on, is mistakes.
Yeah, as Mike Montero says, make better mistakes tomorrow. That was a sign we had in the office. And I think, this business, you're going to be wrong a lot. You just have to be right slightly more often than you're wrong. And when you're right, you have to make more money than you lose when you're wrong. And that margin applied consistently is what will get you. But if you have a trouble with dealing with failure or mistakes, you're not going to make money over the long run.
Yes. And just give you a reference of how often you're right versus wrong. There was just a recent interview with Ken Griffin. I saw a clip of it, and he owns Citadel. And I saw a clip of it on Twitter the other day. And he talked about his best guys at the shop. And he probably has about 200 managers of the money over there. And each one has their own domain. They don't see what each other are doing. So they're all sort of independent contractors, just like I was. And he said that people that survive and excel there are right 54% of days. And that's actually a pretty low number. At Millennium, it's more like 55. Just because I'm aware of the metrics internally there. I was there for a very long time. And laughably, my career is about 58 to 59% of days. My best year was about 64% of days up. And so that's the delta that you're talking about between a manager who's good versus great is literally 3% of days up more. That's it. And that, I mean, but when you compound that, you look at, let's say, 55% of days versus 60% of days. It means that every 5 days of trading or a week, you're right closer to 3 days a week versus 2. And if you're right 3 days a week, that's that out of 5. That means that you could be making compounding 25 basis points a week or so, if not more. And you compound that together, and there's your return. So it's very, very difficult to get that right and the math behind it right. But it does compound over time. And that is the difference between a winner and a loser. And one of the profound characteristics that I've witnessed and embraced is that you must approach it as if you are an amateur all the time, or as I like to say, a troglodyte, and you are a caveman. And you have to approach it all the time like that, where you have an idea what's going to happen, but the probability of you being wrong is pretty high. So prepare for it.
I love that mindset. And it's interesting, that 54% number from Ken Griffin, because I was just talking to someone yesterday who told me about Roger Federer, the tennis champion, gave a commencement speech, and he talked about he has something like an 80% win record, but what percentage of points did he win? And I think he said 56%. And the first thing that popped to my mind was, yes, and he is really good at winning the important points, those big points. He's going to win those.
That's actually what they look at Citadel Millennium, is your slug rate. And that's a big differentiator. So often people are afraid of their best idea, and they don't size it in the book because they're afraid of being wrong. Usually it's an idea that's outside of the benchmark, and usually it's something that's lower weighted in the benchmark. So for instance, one of my better ideas in the book, in the pink book, wait, I'll just pull it up right now and I'll take one up for an example. And I'm looking at it right now. Let's see, Adama, ADMA. I have about a 5% position in Adama. It recently came in about 20%. God knows why, I don't know. And it is a large position at 4.9%. It doesn't even appear in the benchmark. I think that stock is going to double. And so I am going to weigh it appropriately so that we can make a ton of money. The pink investors can make 400 to 500 basis points out of that move in the back half of the year. That's how I do it. And my peers don't, and they won't. They will not do that. Or at least I've never seen it where they will take bets like that based on their alpha. They will simply have a 1% position in this name if they think it's a big deal. And then maybe they'll eke out 50 basis points of net outperformance on the year. And that is a big reason why the performance of many of my peers are incredibly lackluster over a long period of time. They're much more concerned with holding on to their job than they are concerned with outperforming for their investors.
Chris, we look at investment strategy and how do you grow your portfolio over time consistently? What are your thoughts?
Yeah, I just want to touch on the Federer commencement speech first. I love that commencement speech. And I think Federer said that because he lost so many points, the most important thing is that you have to have a very short-term memory, because if you fixate on that point that you lost, you're just not going to be able to move on. And I think that's important in investing, because all of us are going to make mistakes, and you can't fixate on the mistake you made yesterday. You have to kind of start off with a clean slate and move forward again, especially in these times. I feel like every other year since 2022 or 2020, it's like a bull market, bear market, bull market, bear market. I mean, it's just like a roller coaster nowadays. You have to be very flexible in your thinking and being able to reevaluate things on the fly. No, I forget what your question was, but
No, strategy. I think we're getting a lot of gems. But
I mean, I think strategy for us, it's really focusing on high quality growth companies, and we tend to favor service sector companies because we feel like those are less cyclical, very sticky businesses. It's kind of like if you go to your dentist. I've been going to the same dentist since I was a kid. If you find a good HVAC guy, you stay with that guy forever. Those are very sticky businesses, and those are the types of businesses that we like. One of the ones that we had liked in the past is Healthcare Services Group, which is definitely not a household name, not a sexy sector. Their core business was in providing laundry service to nursing homes, so quite dirty business. But they were it was a highly fragmented market, but once they were in a nursing home, unless that nursing home had financial problems, they were basically holding on to that customer for life. I think they had like a 99%. The 99% of the customers stayed on. So, I mean, it was just a very steady growth company. They were growing 15 to 20% every year for many years. But their struggle was that they switched. They decided to get into the food service business. And I don't think they were prepared for dealing with food prices going up and down and having to deal with dealing with commodities and perishables going bad. So that was kind of their hiccup that they eventually had to deal with. But for a long time, it was just a great growth company.
Yeah, great company. And you're right. I think the hope there was that they wanted to cross-sell their cafeteria food into the existing clients that they had. And then they had a rude awakening saying, food business is different than the laundry business. So it took an adjustment. Let's go straight into segment 2.
Stock analysis relies on two primary approaches: fundamental and technical analysis. Fundamental analysis evaluates a company's financial health through income statements, balance sheets, and cash flow reports. Key metrics like price-to-earnings ratio, return on equity, and debt-to-equity ratio help assess profitability and risk. Investors also examine management quality, industry trends, and economic factors like interest rates and inflation. Technical analysis focuses on price patterns and market trends. Chart patterns, such as head and shoulders or double tops, signal potential movements, while momentum indicators like relative strength or MACD, looking at moving average crossings, can help identify entry and exit points. Trading volume and investor sentiment provide further insight into market direction. A balanced strategy may combine both approaches. Evaluating financial fundamentals alongside price trends helps investors make informed decisions, reducing risk while maximizing long-term returns in the stock market.
Mariko, I know that as an analyst, you're great at finding undervalued companies that have some positive catalyst happening. If you can take your CFA hat off for a moment and then you put on your CFP hat, do those metrics that were important to you before, do they matter to your clients today? Because the objectives and outcomes that they care about, I think, are very different.
Yeah, it's been an interesting journey because I used to be, concentrated portfolio, small caps, bottom-up stock picker, held positions for, as long as 10 years, right? And I got to know our companies really, really well. And that was part of the understanding of the business ecosystem that we're in. And then you marry that with valuation, what's going on in the larger market. So an opportunity to see where things are understood. And it's interesting for me personally too, right? Where I've got a portfolio that's well diversified, low cost ETFs. And then I have another that's still like leftover Daruma positions and the odd sort of, stock picking thing. And there is something to be said for the psychic piece that comes, the psychological peace of mind that comes from, you know what, I just have a well-diversified, well-asset allocated portfolio that's in keeping, in alignment with, you know, my investment objectives and everything else. The stock picking is much harder to do, you know, in a non-institutional context. And the opportunities are where there's like dislocation and a lot of emotionality, but it's much less about really understanding individual names. And I find that my clients, right, want to understand the market, and they want to understand what's going on in their money, with their money. And so they want to learn about that. But they're really less interested. It's the conversations are much more about what's going on and what's moving than it is about the individual, you know, the return on invested capital or the asset allocation decisions that are being made in the specific stocks. I'm sorry, this is a long way around Robin Hood's barn. All I can say is I have come to appreciate in my second career, right, the joys of having a well-diversified, well-balanced, you know, portfolio of ETFs in a way that I, as a stock picker, as a professional institutional investor, you know, would have been, oh my God, that's so boring. I'm like, yeah, that's kind of the point, particularly now where like a lot of the market structures. I think it's really hard, if not impossible, for individual investors to do the kind of analytical work unless they know something about about an industry, and they're willing to use market opportunities and are willing to hold things for a long time. I really feel like there's so much information and so much noise that it's you'd be chasing so many rabbit holes that you would not be, your quality of life is just gonna suck if you're not professionally stock picking in certain niches. I think as an amateur, I think it's really hard. It can be interesting. Do it for 10% of your portfolio and learn from your mistakes and have it be as a self-awareness growth opportunity for, you know, your understanding your deeper psychology. Put most of your money elsewhere. Anyway.
David, is that good advice for the non-professional investor? Do you earmark 10% of your portfolio? And I'm curious, like, how do you simplify complex financial analyses for individuals to help them make informed decisions?
Well, I agree. Michael mentioned the 54% success rate for hedge funds, like that make millions of dollars a year. I mean, individuals, the idea that they could replicate that, especially when you bring on the emotions, just doesn't work. But what investors can do, individual investors can do, institutional investors can do, is look at the underlying drivers. So most asset classes, it's driven by the cash flow growth, and what investors are paying for that cash flow growth. And so what we've done at Asset Camp, and I've taught in the past decade, is look at that, understand, you know, the 46 stock markets around the world, growth, value, small cap, large cap. What is the cash flow? What's the dividend yield? What is the expected earnings growth, the historical earnings growth, and what are investors paying for that? And to rank those and look at them from, you know, based on standard deviation, and what is the cheapest, and what appears to be outlier, and use that as guidance for rebalancing to, for example, move out of large cap growth in December into World ex-US small cap value. I mean, the numbers showed that, you know, large cap growth had, of course, those companies are growing, but with a PEs of over 40 collectively, you know, 2 standard deviation more expensive than average, it didn't make sense to continue that overweight that had that.
Hey, Mike T, how do you balance fundamental and technical analysis in what you do? And what risks and opportunities do you see right now?
Well, how you value it, how you should value it, largely based on free cash flows and all those other good things, but how it is actually valued is much more important to understand. And it is not what I think, it is what everyone else thinks. And that's what moves markets. So in my experience talking to investors, and it's been really eye-opening because you may not know, I have essentially had 2 clients for my entire career, Ken Griffin and Izzy at Millennium. And that's it. And my conversations with them over my entire tenure of running hedge fund money, which is, I don't know, 15 years or so, or 20 or whatever, I think would all fit on one piece of paper folded in half. And that would be it. So I never talked to clients until I started running Pink and building this. And now I have the privilege of talking to hundreds, if not more, of money managers that are out there. And the one prominent feature to their entire stock picking prowess is charts. And that's it. And that's all they use is chart trends. And so I actually think the entire world, essentially, including the CTAs and passive flows, have adulterated stock picking to the nth degree. So I actually think it is simply momentum charts that run everything. And when you step off that momentum wagon, you better have a really good reason for it. And I think that's how every book is set up, in fact, or let's say 98% of them. And everyone else simply underperforms, or at least has done for the past decade.
Chris, what are your thoughts? I mean, we're in this world where ETFs are so huge in fund flows. You feel like if you're an individual stock picker, the tail is wagging the dog, right? Because you're trying to make some decisions on individual companies. You've done the research. You find earnings are accelerating, low debt on the balance sheet. Things look great. But at the end of the day, is the S&P 500 getting inflows or outflows?
Yeah, I agree. It's tough because just so much of the market is now controlled by quants and quant flows. And I mean, it's proven that the S&P, it's just a tough index to beat because the S&P has survivor bias. I mean, they keep on kicking out the worst performers and they keep on adding new companies that have grown into something. And that tends to be more good companies. So over time, the S&P has been, I think, a great index to own. And I think Warren Buffett had that bet for many years that the S&P would beat hedge fund returns. And I think he would, I'm pretty sure he won that bet over time. So I think definitely for the individual investor, you just park it in the S&P and don't worry about it a lot of the time. It's you don't have to worry through earnings season and a potential blow up of an individual name just because they pull their guidance or guide even a little bit light nowadays.
Well, here's the question. I mean, what Mike was talking about is that it's more important to make money than to be right. And also, you try to do your valuation work, but at the end of the day, it's ultimately up to Mr. Market. Like, Mr. Market's going to tell you what the answer is. So in this world where there's so much uncertainty around inflation, rate expectations, trade wars, to what extent do we try to anticipate and position our portfolio versus just watching Mr. Market and following a trend? Chris,
Right,
maybe you first, and I'll just go around. Everybody can chime in.
I would say just investing in the S&P and never touching it, I think it's a great theory, but one that not too many people can actually execute, especially in times of distress. People aren't tied to the S&P. Then they're just going to be like, oh, I'll just trim it back or I'll sell it out just so I can sleep at night. And I think the positive with individual securities, perhaps over an S&P 500 in times of distress, at least you can say, oh, I own this company because I know that I'm comfortable with the cash flows growing over time, and I can put a value on that, and I will stick with that. Even if the world seems like it's falling apart, I feel comfortable in owning this company for the next 5-10 years. So I'm not going to kick that out, but maybe because I don't have an emotional tie to the S&P where I can just pump that out just so I could sleep at night.
Mike, how do you anticipate versus trend following?
Oh, that's actually an incredibly good question. And that's why I'm tied to my desk for 12 hours a day. And this is why, if you're not willing to do that, you really shouldn't be trading individual stocks yourself for the most part. So how do I do it? I read a lot, and I think about the setup, and I look at, and when I say the setup is who is where and why, and what is going to change next. Like for instance, before we went on camera here, we were talking about the budget coming up, and people don't put much thought into it, but I think there's a high probability this is going to be a budget busting budget, and we're going to be running well north of $2 trillion deficits for the next year. And where kinetically is that money going to come from to pay for that? And 40% of the treasury buying happens, it's more than that, but let's just say 40 is OUS, outside the US buyers. And they're going to have fewer dollars moving forward because these tariffs are going to be here to stay, to buy much more treasury debt than anticipated. And bonds tend to move on issuance and the supply and demand features, especially for sovereign bonds like the US Treasury. So what's going to happen there? I think that we're going to have really difficult treasury auctions moving forward once this budget goes through. And it might happen a little bit before that. So what I'm saying is you have something that nobody's really paying attention to. And when are new kinetics going to take effect? And I spend a lot of time on that specifically. When and how will they be manifest? And I was starting to put on bets around that right now for those future auctions and what does gold do and so forth. And so I'm anticipating an event that is going to change the kinetics of flow. And so that's what I spend time on thinking about for these more macro moves, is exactly that change in money flows and what happens to those kinetics. Like for instance, Vietnam. And I'm looking at the chart right now. Vietnam just lifted their stock market, is breaking out, and it just went up 15% in a month. And nobody really understands why. I think maybe this panel may not understand. We have this tariff problem. What is going on with Vietnam? Why is the stock market all of a sudden moving? Well, it's because China stinks so bad. And you've seen a unbelievably abrupt departure from manufacturers in China, instantly buying up assets and setting up shop in Vietnam. And so wage growth, I think, in Vietnam is going to go up an awful lot. They're going to have inflation and actually really, really good GDP comps, because the entire world is trying to get the heck out of China and move to Vietnam. And that's why. So I cite an event that's happening. And I talk to a lot of these people that are moving their business specifically to Vietnam, and all of it in a month. I mean, it's astonishing how many billions and billions and billions of dollars are coming into this little country in order to get manufacturing going. And it's going to have a profound impact. So I have this sort of data point that it's soft. I can start to quantify it, and surprise, the stock's already started moving. And so I think Vietnam is going to be a gigantic beneficiary from essentially the decline of Chinese labor. How do you trade it? You go long Vietnam. I'm personally long Vietnam, but I'm watching it right now, and it's moved an awful lot more than I would have thought. But I suppose we're going to find out very soon what the numbers look like. So again, we have an event. I think about the kinetics of the flow, what it's going to do, and then translate into a stock or a trade. And hopefully I can get in front of that.
Kinetics and the flow. Thanks for the insight into how you anticipate. If David and Mariko don't mind me skipping and going into segment 3, unless you guys have something to chime in.
Okay.
Cool. Let's go to segment 3.
Diversification spreads investments across asset classes, sectors, and geographies to reduce risk and improve long-term returns. Strategic asset allocation sets fixed targets based on risk tolerance and goals. while tactical allocation adjusts holdings based on market conditions. ETFs and index funds simplify diversification by offering broad market exposure with low fees. Position sizing helps manage risk by limiting exposure to any single investment, while stop-loss orders in hedging strategies protect against downturns. Regular portfolio rebalancing maintains the intended asset mix and risk profile. Conservative investors may favor bonds and dividend stocks, while aggressive investors lean toward growth stocks and alternative assets. Blending different investment strategies and maintaining disciplined risk management allows investors to navigate market fluctuations and achieve financial goals over time. A well-structured portfolio provides stability, growth, and resilience in changing market conditions.
Chris, at College Retirement Equities Fund, the majority of funds were indexed, and then an actively managed part of the portfolio was smaller. It looked closely at, are you overweight? Where are you underweight? What's your tracking error? Compare that to what you do now. And how do you construct portfolios that are resilient to market cycles?
Yeah, we constructed very differently. I would say that, when I came into the industry at CREF, we weren't allowed to have any cash in the CREF growth accounts. And that was definitely a struggle in the year 2000 when the market was melting down after the internet bubble. My secretary would come to us and say, hey, why is my 401k going down every day? My boss's hair had turned white. I kind of felt like there has to be a better way. Luckily, our father, Sam, had really focused on managing risk in different business cycles. And that was really his real key philosophy. And he had avoided Black Monday in 1987. So I know you and I definitely felt like we had to learn from our father. So we definitely believe in risk management. There are times to be offensive and aggressive, and there's time to be more defensive. So I think, just giving an example, I mean, if we're managing a balanced account, which is typically kind of a 60-40 portfolio, during the I'd say year 2020, after the COVID lockdowns and when they were going into reopening, when we saw GDP accelerate to over 10% and zero interest rates, we were very aggressive. We felt like it was a good time to be investing just because you saw huge earnings accelerations coming. So we shifted that more toward an aggressive stance into equities. And then in 2022, we saw comps that were going to be impossible to comp. And you saw the Fed ready to hike interest rates for the first time. So those were two very dramatically different economic environments. And I don't think it makes sense to be static and have the same investment philosophy at that time. You can't just have the 60-40 portfolio. It doesn't make too much sense, especially if you feel like you can, you know where you are in the business cycle and you can maneuver.
Mariko, how do you approach rebalancing a portfolio? What triggers a need for adjustment?
So there's two things. I mean, as an institutional investor, I had a no position greater than 10% rule. So in practice, because I had a concentrated portfolio of 25 to 35 stocks. So in practice, anything north of 5 got to be big. But on the other hand, there were no little positions that didn't matter. So I'm with Mike on that one. You had at least a 2% position. So these positions were big relative to my benchmark, which is the Russell 2000. So the rebalancing, some of it was just forced, and you had to look and go, all right, well, if it's below 2, do I want to buy more here, or do I want to sell? And but if it went above, there was sort of a forced trimming. And then those assets, that money got redeployed. And because I was running institutional money, I was expected cash was never more than like 5% of the portfolio. So actually 10, but usually we ran fully invested because the asset allocation, the broader asset allocation was held in the hands of our investors. We were hired to always have full exposure in the small cap slice that we were chosen. For individual investors, when money comes in, or it's interesting because with individuals, you have a whole tax issue that's very important, and that can cause some rebalancing problems. So there's a complexity there, in that you don't just have to take into account the exposures, but you also have to look at tax, and you have to look at other ways to make that happen. But I just think I get excited when stuff is down, and I'm with David. When you have a 2 standard deviation plus, like, pay attention, both as an opportunity and as a time to rebalance, let go of profits too. So the extremes, money is made at the inflection points at the extremes. I don't always try to predict where the inflection point will come, but you can feel it, you can see it in what's going on, and when there's a mismatch between emotions and fundamentals, that's usually a great time to rebalance.
Mike, talk about portfolio construction, because I think that you have some bellwether holdings in your portfolio that you love fundamentally, and you kind of leave those, and then you're actively trading maybe shorter term positions around those. And then what role do options and other derivatives play in your risk management strategy?
Well, personally, it plays a pretty large role. The Pink Fund doesn't have any options in it, so it's just straight stocks. But so far as constructing a portfolio and thinking about risk management, like for instance, it depends. You have to realize that risk for a index, or let's say an ETF manager who's benchmark versus an index, is much different than risk for an individual investor. Like for instance, Pink has an extremely risk-on book right now. That doesn't mean that I think stocks are necessarily going to go up or down. I just think that my stocks are going to go up versus down. And the portfolio looks very, very, very different than the benchmark. For instance, I'll just go down the names, top names in the benchmark: Bristol Myers, Vertex, Gilead, Pfizer, Amgen, Merck, let's see, Johnson & Johnson. Those are all huge in the benchmark, and Pink owns 0 or near 0 of all of them. So that is a very, very risk-centric, or let's say idiosyncratic book. Whereas in my personal fund, it's all just best ideas, stocks. I probably have 5 different strategies right now on my book. Usually it's fewer than that. Usually it's about 3. But right now there's a lot of moving parts around trade tariffs, around transition of businesses out of China into Vietnam, Argentina, for instance, a lot of OUS exposures, and then fundamental bottoms up companies. Like, I think personally that Reddit is going to blow the heck up. And Apple, I think, is in the process of blowing up, for instance. So what do I want to be against that? I want to be Pan W. That's Palo Alto Networks. I want to be long utilities, because that's a pretty low risk way to play the build out. Even though like UTs shouldn't work well in this environment, they are working well because the earnings are going to be better. I'm long Dell, for instance. And so I have paired books on that are really fundamental bottom up. And then I'll have many other strategies. I have an interest rate strategy on that has a lot to do with bonds and gold. And then I have a OUS exposure tariff sort of book on. So it's rare for me to have so many different strategies on at the same time in my personal book. But that book is run much, 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 much differently than Pink. Pink is all about outperforming healthcare, and that's how it's set up.
Well, thank you for some insight into your book. Since you've blurred out your background, we can't read your whiteboard to see what your
I've started
ideas
doing
are
that
there.
just to limit my tweets, because as soon as somebody sees that board right there, they go absolutely ape shit. And I just get 100, I get thousands of inquiries, and it's just too much. So I've decided to blur it out for now. Maybe I'll turn it back on. I don't know.
David?
Well, I think, Mike brings up a good point. He talks about outperforming as the objective. As individuals, investors, our objective is not to outperform. We get one shot through time to steward our retirement assets. And the protecting on the downside can be very helpful, but we're compounding our capital over time. And so it's not picking individual stocks. And I think we've shown in this hour how challenging that is. And for those that do it well, how they're at their desk 12 hours a day. But as individuals, we can't just naively invest in the S&P 500 and hope things will go well. The S&P only US makes up 65% of the global stock market. The S&P outperformed because 2 to 3% of the outperformance was because the stocks got more expensive over the past decade, whereas non-US stocks got cheaper, the dividend yields are higher, the earnings growth is not that much different than US earnings growth. And so I think, our job as allocators, as investors, is to understand the drivers on the bond side, on the stock side, and manage more like an endowment or foundation that is stewarding capital over generations. That's more like how individuals should invest, rather than speculating on individual companies or futures or any of that. It's a much more of an institutional approach, because we get one shot through time. And if we screw it up, it's going to be a challenging retirement.
Unfortunately, most of the time, individuals don't know how to do that. They're getting like water cooler ideas and saying, oh, that sounds interesting, I'll buy a little bit. And then they do that 20 times and they've got like a portfolio of like all tech stocks.
Well, if they do that on the side, they do that with their funny money, but most of their assets will be in their 401k anyway.
Yeah.
And there they should be more like an institution or an endowment, allocating long-term multiple asset classes. That's why those portfolios are there. And that's how individuals should invest primarily. And then they can play around with stock ideas on the side. And as Mariko said, learn from their mistakes, which there'll be a lot of them.
And that's the perfect segue. Let's go into segment 4, talking about psychology.
Behavioral biases can lead to poor investment decisions. Loss aversion makes investors hold on to losing stocks too long, while overconfidence can result in excessive risk-taking. Confirmation bias leads to ignoring contrary data, and herd mentality pushes investors to follow market hype. Emotional investing, such as panic selling in downturns or chasing past performance, often leads to losses. Developing a disciplined long-term mindset helps investors stay committed to their strategy. Dollar cost averaging reduces the temptation to time the market by investing fixed amounts at regular intervals, averaging out price fluctuations. Investors should use data-driven decisions, challenge assumptions, and stick to their plan. A behavioral investing checklist helps ensure rational choices. Avoiding impulsive reactions and focusing on long-term goals strengthens financial resilience and prevents costly mistakes. Managing emotions is as crucial as choosing the right stocks.
Mike T, in high stakes trading environments, even the best hedge fund managers blow up. And I think this has been a challenging environment.
That's actually not true.
No?
It's the worst.
Well, you tell me about funds that have had to unwind their positions because guys couldn't
right now
hold on to their book.
Yeah,
And
a lot of times it's liquidity. Liquidity is a real problem, especially for a lot of hedge funds that have dabbled in these small cap and mid cap sizes, and they're it's not a big deal when your book's $1.2 billion, but then all of a sudden you have some success and now you're running a $7 billion book. and every stock that you touch, you're 5% plus of the float. And so you can't get out. And that's something that recurringly, I'm a reference for many, many allocators, especially in healthcare, because I know most of the managers, and they'll call me up and say, what is this manager like? What are they doing? What is their style? Because they're looking for a reference point, outside of the pitch book. Who is this person really? And for the most part, for the more senior managers that are out there, I've grew up with them, and I know them as a young man with hair. And so I can help with what the sticking points are. And one of the big sticking points I go back on all the time is the exposure to small cap. And it's not because it's a bad idea. It's just a bad idea if you can't get out. And that's something that we've been witnessing right now, especially in this most recent sell-off that we had, a real problem with that.
So give us some Mike T maxims. How do you quickly admit your mistakes? And sometimes, like, how do you mentally reverse your positioning really quickly if you have to?
Yeah, well, I look at my progeny, if you will. I look at the managers, today's gladiators in healthcare that I trained over the past 20 years. And most of them are my best friends in the world. And I talk to them every single day. And one feature that is unique around that group is that within a 15-minute period, your biggest long can turn into your biggest short. And that is a very, very, very rare attribute to have. And that, when the facts change and the fundamentals change, it's not about getting out, it's about getting short and flipping your entire book. Because if everyone was thinking what you were thinking 15 minutes ago and everything just changed on a dime, that's actually a really, really good short, because most won't respond in that sort of period of time. In fact, I'll give you a stat. Here's a stat. This is a great one. And it also applies to your biggest shorts becoming your biggest longs. Citadel in their risk management discovered that every short, or not every, well, they looked at every short I did. Every short that I did that I covered within 2 weeks, outperformed the group 80% of the time. And that number is absolutely stunning, because I don't have personally an 80% rate on success. But if you simply take my short book and you go long my short book 2 weeks after I cover, you will outperform 80% of the time. And I'm absolutely certain that firm, that was Citadel, took that analysis of my book and made their own book on top of it to trade my short covers. How about that? And that's what really happens when you take a look at the math of the people behind the curtain that are running what they're running. They do that analysis to look at, what is his slug rate? What is his slug rate when he covers? Holy crap, that's free money. We should just go long everything that this guy covers after he covers it within X period of time, because 80% of the time it outperforms after that moment.
Interesting to see where the information content is.
Yes. And so it's a whole different way for these hedge funds to analyze their portfolio managers and learn how to make money off of them without them even knowing it. That is a big piece of what goes on in managing money. And very few people are aware of it.
David, what psychological biases do you find most detrimental to investors, and how do we overcome them?
I think one of the biggest ones is gains feel worse than losses. I'm sorry, losses feel worse than gains. And so that forces investors to want to get rid of the things that aren't going well in their portfolio, as opposed to understanding what's driving it, what happened, and where are we going now. But the other thing we can do is not look at our portfolios often. If you're an asset manager, you got to look at it daily. But as an individual investor, if we know that losses feel worse than gains, then don't look at your portfolio every day, because the market goes up and down every day. And so if we keep exposing ourselves to losses, and that feels worse than exposing ourselves, when we see a gain, then our approach, and even as institutional investors, look at it once a month. Like, formally look at where things are, look at valuations, look at earnings, look at what's driving the market once a month, and that can help control our emotions. And because then we're not exposed to all the noise all the time, most of which we can't act on anyway.
Less can be more. Chris, you mentioned how the cycles are much faster. The bull and bear markets seem to be happening annually. How do you help clients navigate that fear and greed to be more rational? And how do you keep your own emotions in check?
That's a really good question. It's not easy all the time. I mean, I think we're all humans. We're all emotional. I think one way is that sometimes you just have to step away from the screen, especially on crazy days. I don't know. It doesn't help just staring at the Quotron in a sea of red. It doesn't help you. And then I would say a lot of the time it's avoiding the headlines and reading. I think one of our friends who's also been a very successful investor, he said that you don't want to read the news headlines until the weekend. You read that on Sundays. And a lot of those worries that were during the week have not come true. And the rest of them you go to church for, and you pray that they don't come true. So,
Chris, I think there's a lot of that going on right now. And,
for sure.
And I would submit, though, that prayers are required, because it can't be truth that you're looking at. It must be faith. The way that we're looking on our sovereign debt is absolutely insane, and we cannot stop spending, or we will have a meaningful recession, and that's politically unpalatable. And so they won't do it, and they will continue to spend with insanity until the bond market stops them. And I don't know exactly when that's going to be, but it is soon. And that will be the most painful thing that we could ever experience, far worse than any recession, because this one will be of long duration, and you'll have a interest rate problem, and you will have a currency problem, and you will have a government spending problem all at the same time. And you now have what looks like to me is that we're going to have a federal budget that is augmenting the GDP to the tune of 8% a year, which is astonishingly high, and laughably high, especially at a time of full employment in a non-war environment. They have gone off the rails. The face is, you're neck deep into a bag of cocaine, and you know what I'm talking about, Andy. So
I don't know what you're talking about.
I don't know what you're talking about. My dad might be listening, and that's a truth. That's a truth of what's happening. And so the prayer that you were referring to is that, well, I hope nobody witnesses that truth today or this year. And that's why I think we're seeing these economic cycles that are becoming closer and closer and tighter with greater volatility. That's because the ice gets thinner and thinner and thinner. And the final break is going to be where, we're Japan. And Japan could do it, meaning that they've had economic cycles and full employment, and they cannot stop printing money. Can't stop printing money. And now I
think Japan's a little different in that if you look at their national debt, it's 78% of GDP. I mean, where Japan differs is they were running a social security crisis, and they took their assets and they invested in the stock market. So much of their borrowing is actually backed by assets on the stock side. So it's very different than the US situation, which it's a true deficit, and they don't own anything. And so I agree with Mike that it's definitely a concern, especially this budget cycle.
Absolutely. Well, they can't stop. And I'd argue that the reason why they're buying the stock market with printed yen is because the flows would actually be negative. The population growth is negative. The withdrawals are more than the money put in. And so they have to offset that with printing money in order to keep asset values up. And now they have a problem of inflation. as the government has overspent, much like ours. And so they are, but what's much different is that all of this is internally sort of contained, where they force the pension funds, endowments, and everyone else, insurance companies, to buy more and more allocation to the JGBs. And so they could internalize all of it. Whereas in the US, we have to find 40% of our buyers, a bit over, outside the US. And so we can't create laws and force people to buy that. That's the problem. That's the difference between the US and Japan, and that we can't do what they have done in order to smooth over that volatility. And that day of reckoning is coming. So, Chris, I'm with you on the prayers. I think I may start going to church more regularly. I'm kind of like a Christmas dude, you know, and maybe I'm going to throw in an Easter too. So.
We'll see if you start wearing a cross, like Pete, around your neck.
People would think too, that's actually that's a X, not a cross, and I'm the target. So I won't do the cross.
Mariko, I didn't give you a chance to chime in on this one.
You mean just about the world going to shit? Yeah,
basically,
I'm worried. I mean, the three things that would really, get, because as everyone, I was like, no, keep calm and carry on. Here are the three things that would worry me. If Trump got rid of Powell because, like he has everything else, if the dollar stops being the currency of choice, and if we decide that our sovereign debt is, like, not really a serious obligation, right? Then, like, those are the fundamental pillars on which modern finance are built on, right? Treasuries are risk-free, everything else. But this, the what's going on with the deficit, it's just not sustainable. I mean, it's a problem. It has to be addressed, and there is.
So walk us through that. Walk us through the addressing part. What would that look like?
You mean
everyone says it must be addressed, but nobody says how it's addressed.
Well, I think you have to do a little bit of everything. So everybody has to be unhappy, and I think there also has to be
So give us a number. Give us a number. For instance, Doge has been hamstrung, and they would get $1 trillion in cuts. None of it's going to happen. But what would $1 trillion in government cuts look like for this economy?
I think it's not just cuts. I think you have to, it has to be everything, right? Mm-hmm. So you raise some taxes, you have to cut some spend, you have to be more efficient in the spending. We look at healthcare, we look at entitlements, we look at the tax code. I mean, I think, I think everything has to be done. And to your point earlier, it's politically unpalatable. So I don't know if we need a big ass crisis for people to gather behind something that needs to be, and say, all right, we're all going to make a collective sacrifice and make this happen.
After watching this,
you can't have interest expense be more than your defense spending, among others. And
I'm certain that's what's going to happen.
Yeah. So
I'm certain we are not going to stop spending, and we will only be facing it when we are at a meaningful crisis.
Exactly.
Yeah.
I agree with you. And what that exactly is going to look like,
it's easy what it looks like, right? It looks like the long end of the yield curve trading well above inflation.
Mm-hmm.
That's what it looks like. And we're probably there, just about there right now, where it's starting. And, Yellen started losing control of the yield curve last year. You could see it. And so she moved a lot of the issuance on the very short end to get away from that. And at issue is that the amount of debt to be parlayed by Scott Bessent over the next year. Again, you're going to have to find those OUS buyers. And wow, this is going to be quite the dance to get this done. And every year, I think it's just worse. And, so I assume that's what is going to happen, and we're probably going to see the beginning of a material treasury problem in the next year, depending on how this budget turns out. I do not expect any material cuts here. I expect the deficit to go up materially coming out of this.
I agree, and I think there's a generation that has only seen declining rates and or weirdly a very atypical situations on the low rates and
cheap money.
Yeah.
Well, you also have to remember that in the past, when we did have an economic cycle, the tax receipts to the government dropped an awful lot, and we would normally run a deficit. But it was only temporary, short-lived, and it was material, but it would be short-lived. And now we're at a point where we can't do that. This is why I think they're in a panic to never, ever, ever have an economic cycle again, because I think there's a decent chance next year we're looking at a 8% of GDP being deficit spending, but under recessionary conditions where the tax receipts drop, that could be something like 3 trillion more than that, 2 trillion more than that, right? And think of the numbers here, though. The government's bringing in $5 trillion in tax receipts, and they're probably going to spend close to 8 trillion next year.
Yeah.
So we're over 50%. They're spending $1.50 for every dollar they bring in, and they're putting it on the credit card. And you model this out, and you're like, that's kind of never going to change, and that's it. So, yeah.
A plug for the folks at the Yale Budget Lab, because I really like the work that they do and the analysis that they do, and it's also very kind of timely as information comes out. They're rerunning numbers and stuff.
I don't mean to be depressing on these issues, because our job is to allocate folks' capital. I just think that they should be aware, if they aren't already, that we've got a gigantic cloud hanging over our heads, and they're just kind of spinning the plates and hoping that somehow that day never comes. That day is literally, well, it's happening in a lot of places, but for the US, it'll be, oh God, I don't even want to know. That is my biggest fear. And I talked about it 4 years ago when I started coming public, is that my fear from COVID was that we would never be able to stop spending like we were. And that's exactly what's happened. And
that's what's been happening.
That's it. And they just can't stop spending, and they won't stop spending. And what's
when they
different
can't stop cutting taxes also, though. I mean, it's not just, as Mariko was saying, it's the taxes also. The deficit started ballooning out during an expansion after the tax cuts of 2016, 2017 in Trump's first term. And the House seems set on cutting taxes again.
Correct.
And so it's a combination, but it doesn't have to be a disaster. I mean, the average interest rate right now is 3.2% on the debt. The GDP is still growing at, on a nominal basis, 4 to 5%. If it can grow faster than the average interest rate, and we can actually bring down the deficit spending to where it's 3 to 4%, then the U.S. can operate with 150% debt to GDP. Greece is doing it, and their treasury yields are 10% or 1% less than ours, and so it doesn't.
Who owns all that Greek debt, by the way? Who owns all that Greek debt? The central bank.
Well, right. That's what I'm saying,
Yeah.
but it can be done. Like,
Well,
the central bank owns a lot of our debt too, and so I think that
Greek debt
this has
is
been a
completely
crisis
contained,
that we've talked about for a decade. When back in 2011, when the S&P lowered the U.S. credit rating off AAA, and so I agree with Mike. There's big concerns, but I think that it is a problem that, if as Powell said, there were adult conversations that could be solved. It doesn't have to be a disaster.
Let's go bring it home to the last segment. We'll see if we end on a lighter note, or if we hunker down in our bunker and discuss where we're going.
Markets move in cycles, shifting through expansion, peak, contraction, and trough phases. Understanding these patterns helps investors anticipate risks and opportunities. Economic indicators like GDP growth, employment data, and corporate earnings provide insights into the current cycle. During recessions, defensive stocks in consumer staples, utilities, and healthcare can offer stability. Investors may also find opportunities in undervalued assets. In bull markets, growth sectors lead, but maintaining a balanced portfolio prevents overexposure to risk. Reassessing an investment plan is essential after major life changes or economic shifts. Adjusting asset allocation based on risk tolerance and goals ensures long-term success. A disciplined approach, staying invested, avoiding panic selling, and using a diversified strategy helps navigate market fluctuations. Understanding cycles, managing risk, and adapting to change enables investors to build resilience and sustain long-term growth.
I'll start with Mariko. What lessons have you learned from past market cycles? And then given the last segment where you shared some of your fears or concerns, how would that change your personal investment style or how you advise clients, or does it not?
All right, so there's a lot of questions in that hairball of a question you just landed me. Early on, I worked with Chuck Royce, who's a small cap value investor, right? And in 1987 on Black Monday, I was a young analyst. We were buying stocks. So even if you weren't sitting on a huge cash position, because again, I don't recommend that you try to market time. It's because the best days are often right in the environment of the worst days as well. But there's an opportunity to upgrade what you hold in the portfolio. And it was such a calm day. I mean, we were doing our thing. He's standing by our tree. We're buying stocks hand over fist. And then when I went home to the Upper West Side, I saw people wandering around the streets looking shell-shocked, like you see after a disaster, ties askew and hair like this, And I realized that for the most of the finance bros, right, it wasn't that. It wasn't this great buying opportunity of a lifetime. So I've seen many of these cycles, and I had clients that used to love to come to me when there was blood in the streets because I was excited and it was different. So I think you have to be wired a bit like a mutant. In terms of what to do, I mean, that is a question, right? Because where the hell are you gonna go, really? I mean, there are your other asset classes, so I think you just do. I mean, for me, I long bonds, nope, no thank you, at all, because of all the things that we've talked about. So I would say more like anti that. Definitely getting, our my clients who are very US centric, very Mag 7, more international. More small cap, a little bit more in some of the emerging markets. I'm with Mike on that. But we're part of a system. We're part of a global ecosystem. You bury. I have a client who's a landscaper, buried $100,000 in the backyard. And I'm like,
what's his address?
Right, exactly. And this is in Hawaii too, right? So it's like, that's going to be a biology experiment in about 30 days. But it's just one of those things where you go, you've got inflation. It's going to be a problem. I think at all times you do the best you can. It's kind of like how we have to show up as humans in the world. You do the best you can in accordance with what you have. So you have to be balanced. You have to be rational. You have to have a go bag. By the door too, but it's not like I can say, oh well, definitely put it all in crypto or put it all in gold or put it all in nuclear energy. I mean, there's a kind of innate dynamism and resilience in these very complex dynamic systems. But are there going to be stressors? And yeah, and could they be really bad? Yeah, but I don't have a golden parachute kind of strategy.
No easy answer.
No, that's Mike may have some easy, some tough, well-deserved answers. But for the average investor, I think you also have to back to right. There's a lot of conventional wisdom, but people's circumstances are very individual, and I think sometimes people are just happy to get other people's assets to manage, and they're not looking at their own individual financial ecosystem and also a lot of tax considerations, and also wealth building is one thing, and then decumulation and that phase of life is a different one and very complex. And I would say all the things that we're worried about are most worrisome for that demographic elephant going through the snake right now, that is going to be all the baby boomers. I'm at the very tail end of that, but this kind of what we're talking about is going to affect them the most potentially when you're in that decumulation phase, and they tend to us cranky old folks tend to vote, and we don't always think about our grandchildren when we're like worried about the Social Security benefits. So I don't know. It's interesting times. You just do the best you can. That's what I've always done.
David, you sounded constructive on the debt situation. How do you advise investors to adjust their portfolios to different phases of the market cycle?
Well, first off, you're massively diversified. So if it's debt monetization, you own real things. You own gold and should have owned gold for the past decade. You've owned Bitcoin and should have owned Bitcoin for the past decade. You own other real assets such as real estate. And I mean, there are dozens of asset classes you can get exposure to, understand what drives it, which is speculations, which gold and Bitcoin is, but you also have the cash flow generating assets. And there is the opportunity to look at market conditions and rebalance the areas that are more attractive and have lower valuations, and to think like an allocator, because that's what you're going to need to do. And I agree with Mariko. You have a go bag, right? Have assets away from the financial system, be that food storage or, if you're into guns, ammo, whatever, just don't be completely tied to the S&P 500. Have a life outside of the financial markets, and you can maintain that flexibility even if we get a debt crisis. When you think about Japan, like they owe it to themselves. Like the wealth of the country is the private sector and the ability to create and that dynamism, right? It's not accounting, government debt, it's accounting, right? And it can be solved. But if the actual rule of law and the pillars of the economy is destroyed, and it's impacting the private sector, and they're acting based on fear because they don't trust the court system anymore, that's when you have a real problem. But the debt in and of itself is not a problem. It's what happens because of it.
The other thing I would add, and outside of finance, right, is in tough times, I mean, community, mutual aid, right? We have to tap into our humanity, and have those, and there's so much about technology and everything else that's isolating and fragmenting as opposed to the gathering. But I think when there is crisis, there's also an opportunity for the best side of human nature to come through. And I think starting to cultivate those intangible assets is important.
Chris, you mentioned there are times when you should be more aggressive. There are times when you should be defensive. How do you incorporate those like macroeconomic variables into an investment decision?
Yeah, I mean, we're always looking at business cycle, and we have a philosophy called METV, where we're looking at monetary, economic, technical, and value indicators. And we try to look at, it's like 60 underlying variables underneath those, and we kind of get a positive or negative reading on each of them, and come up with should we be aggressive or defensive. Right now, I feel like it's pretty much neutral. But I mean, a month ago, I would have said we were negative. So I don't know. Things change very quickly, especially in that technical category. I mean, it was incredible how fast things changed. I don't know. I think maybe it is a factor of the changing market dynamics and the amount of quantitative investing that goes on now. Just the swings back and forth are just they're enhanced on both positive and negative, I feel like. So I don't know, the momentum swings so hard to the downside, and now in the last, I guess, 6 weeks is to the upside. So it's been an incredible rebound to watch. Kind of reminds me of the COVID rebound, but I don't know. We didn't have the stimulus yet. But I don't know, maybe the market, I think Andy and I were talking about it yesterday. I think the market might be just pricing in that these tariffs just totally disappear because there's a few court cases that are in the courts of international trade saying, are the actions of the administration even legal? So if that ruling goes against the administration, do the tariffs just totally evaporate overnight? And countries are just like, oh, we don't have to negotiate it anymore. I kind of feel like that's what the market is telling us right now.
Yeah, is the market pricing that in as well as what Mike's talking about? It's like what the government's going to be doing if spending doesn't slow down, it will be stimulative. Mike, if deficits keep growing,
yep,
you just have to hide in gold.
You have to remember, and this is like the 101 fractional reserve system. And that's like old school from your college days. If you had a finance class, you'll remember that every dollar or every unit of currency, for the most part, is borrowed into existence. And for instance, we talked about Japan here a lot. You borrow $1 million, you have a hurdle rate attached to that. Let's say 5% yield on $1 million. And you take that $1 million and you open a restaurant in Tokyo. It's the greatest restaurant ever. You have 100 tables and it's packed on day one. I promise you, by the end of your career, 30 years from now, only 70 of those tables will be filled because the population is going to drop by 30% over the next 30 years. And that's the case for most industrialized nations. But that coupon that you owe on that debt will not stop, even though your scale deteriorates and your utilization of capacity deteriorates all the way through that. And that is absolutely what's going to happen over the next 30 years. And the fractional banking system is not designed for serially negative demand year on year because of a declining population. And we're witnessing right now the government's trying to offset that by simply spending more to make up for that slack. Right now, that's what they're doing. To keep growth alive, they're now borrowing and spending and borrowing and spending, and we see it everywhere. That will not stop because that's politically what they can do. And it will turn into what we're starting to see now, which is people not believing in the ability to pay this off or pay it off without printing money. So I expect for the next 30 years, just serial money printing left and right until something breaks. And that's my outlook for the next 30 years. And it's really born on demographics. Now, people can say we're going to have incredible productivity improvements because of AI and so forth like that. I agree. Much like the iPhone and handheld technology really changed communications and improved productivity. Email, now you get bothered at home to do work, which you end up doing anyway. So you're more productive. And so that is going to be an offset. But there is no offset to the population dropping by a third over the next 30 years. So that's really the outlook for me. Now, yes, hard assets, absolutely. I think hard assets is a place to be. And I am working personally towards all of those hard assets over the past 5 years. I never had the opportunity to do it because I was running a hedge fund and I didn't have any time to do it. But that's what I've been spending most of my time on personally, is working on hard assets that generate free cash flow businesses. And so I'd recommend that to all of the investors out there. Get involved in a business, something that does have pricing power, that can be held to at least inflation, and have your go bag, and realize that, I believe the equity markets and debt markets moving forward are going to have much more volatility and much closer, the sequence of events. These economic cycles are going to get tighter and tighter and tighter. And it's such that now that we can never have an economic downturn because bond markets will blow up. So that's what I think is a truism that is much different than 20 years ago.
We're going to leave it there. I want to thank the panelists for delivering way beyond the allocated time. This has been an incredible conversation. A huge thanks to David, Mariko, Mike, and Chris for sharing all the insights and strategies, whether we're talking about value versus growth, risk management, or psychology of investing. I think we covered it all. And one of my big takeaways is that this market is so dynamic. The world is changing so quickly that you have to be adaptable. And if we need to have a go bag ready to go, maybe we have to have a go bag ready to go. So have a plan. And I think that's what it's all about. So your assignment for this week, just take 15 minutes and review your current investments. Ask yourself, am I clear on why I own each holding? And if you can't answer that confidently, dig in, look further, and consider holding gold or hard assets, and watch this episode 5 times and share it with a friend who you think would benefit. If you enjoyed this episode, follow the podcast, leave a review, and you can always connect with me at inspiredmoney.fm. Inspired Money is created and produced by me, Bradley John Eaglefeather, who edited the segments, and he's the behind the scenes guy for the live stream. Chad Lawrence does our graphics, animations, and editing. The biggest thanks to our guest, David Stein. You can find him at moneyfortherestofus.com. You can find him at assetcamp.com. David, anything else you want to share that's going on?
No, I enjoy. Thanks for putting together the episode.
Thank you for joining for so long, especially when you're traveling. Mariko Gordon, you can find her at uzumellc.com or marikogordon.com. Mariko, any events or things that you want to share?
No, I have a weekly newsletter where I riff about mostly personal finance for individuals, but often have TMI, but people find it useful.
People should sign up. My wife reads it, I read it, and then my wife reminds me to read it again because she says, Mariko wrote something really good this week. Mike Taylor, you can check out the Simplify Healthcare ETF, ticker symbol PINK. Read more about it at simplify.us. And just a quick plug to Mike's son, Max. Catch him on the racetrack. What races are coming up, Mike? What races should we be watching on TV?
He will be racing. Heck, he's racing this week. We got to get on a plane tomorrow. My son races the development level IndyCar series. And this year he's racing something called Indy Next, which is one level below professional IndyCar. And his next, it's on Fox Sports, broadcast usually on Saturdays or Sundays when they're racing. And his next race is going to be in Detroit for that. And I'm looking at it right now without my glasses. Next week, Saturday and Sunday, the 31st and 1st of June. You can catch him on Fox Sports. Max Taylor, he's in the big pink Susan G. Komen car, and it's a lot of fun. It's a lot of
And
fun.
driving as a 17-year-old at
He's
a
17
professional
years
level.
old. He's the youngest guy on the grid, and we're going to see what happens. But so far, so good. And
We'll be rooting for Max Taylor.
thank you. Thank you so very much.
And Chris Wang, my brother, managing partner and director of research at Runnymede Capital. You can find both of us at runnymede.com. Chris, anything that you want to pitch or share, plug or share?
I don't think so. Just we write a bi-monthly newsletter. You can subscribe at runnymede.com. We alternate, but the month goes by fast. I don't know where the time goes nowadays.
And sometimes this guy forgets, and Chris has to remind me, you didn't write the newsletter yet. So thank you, everyone, for joining us. I really appreciate you joining. The next Inspired Money episode will be next week. We're talking retirement income strategies, maximizing returns for peace of mind. Maybe a good follow-up to today's episode. That will be Wednesday, May 28th, 1 p.m. Until next time, do something that scares you, because that's where the magic happens. Thank you, everyone.